All right, welcome back. My name is Carlos McWhorter, CPA, and today we have a stock analysis of Walmart, the number one retailer in the United States. We're going to take a look at the fundamentals to see if it's a quality business or not. And then we're going to take a look at the valuation towards the end of the video to see, is this a good time to invest in Walmart or not? So let's dive right into it. Let's not waste any time. So we're looking at Walmart right now, $779 billion in market cap. Enterprise value, $840 billion. For those that don't know, the enterprise value is often referred to as the true cost of the business. You look at the market cap, you take away cash because that's a benefit, then you add debt because that's a true cost, and that gives you your enterprise value. We're at $840 billion. PE of 41.8, kind of high for a very mature company. So we'll see if that is the case. Stock is trading at $97.45. A beta of 6.69. That means this stock is not as reactive as the market. So it's less volatile than the overall market. So this would be a defensive stock or a solid dividend income stock if you were looking to invest in this company. So this is something to add to your portfolio to diversify, not a high growth stock. So dividend yield right now over the past 12 months, 0.91%. Looking at the recent 10-year stock chart, we see it's a pretty strong trend. A lot of capital appreciation as of late. However, a pretty strong uptrend over the past 10 years of this stock. So let's get into the business segments. How does Walmart make their money? Where is it coming from? So we have 13% of the revenue coming from Sam's Club, 18% coming from Walmart International, and 69% coming from Walmart United States operations. So that's how their revenues are split. So looking at the revenue and margin trends, let's see. First thing I like to look at, how many years did the revenue decline? So right now we have 1 year, 2016. Over the past 10 years, revenue was down. Every other year, revenue has been growing. Now, we do have some slow growth here, but however, kind of picks up. We're averaging 3.5 over the past 10 years, 5.4 over the past 5 years. So over the past 5 years, Walmart's growth has accelerated. That's what that is telling me. Low growth, but this is a mature company. So this is what we would expect for the number one retailer. They're in a very mature industry, and it's a very mature company in a mature industry. So you can't expect a lot of top line revenue growth. So, but there's other aspects of a business in this stage that we want to see when we're looking at this. So we have $482 billion in revenue in 2016, $680 billion in 2025. Their fiscal year ends in January. So as of January 2025, $680.9 billion in revenue. So this is the growth I would expect to see from this type of company. So looking at the gross profit has grown just about every year. Only 1 year, 2020, of small growth, which makes sense during COVID. Then we have solid margins, 25.1, 24.9. Margins are pretty much in that pocket around the 25% range for gross profit, which makes sense for a retailer. Let's go to profit and take a look at that. Looking at the net income, the net profit, we have a different story slightly. We have 6 years where they've been profitable every year, but the revenue, or profit, I should say, declined. So 6 years of decline. Again, not necessarily something that's alarming. We can expect this from a mature company. When companies are at the top of the mountain, they're not going to continue to grow at a fast pace, and profit is going to be up and down. But as long as it's somewhat consistent and solid, we can work with that. So 2016, we have $14.6 billion. 2025, $19.4 billion in net income. Margins are pretty solid in the pocket of around 3%. Over the past 5 years, 2.4% net profit margin. We have 2019 and 2023 as the low years looking at this trend, but been growing at 7.1% over the past 5 years. I would say solid growth for the bottom line for a mature business of this size. So that looks good there. Let's look at free cash flow, see if we're seeing the same story as we're seeing with the profit. So first thing we look at, negative growth years. 1, 2, 3, 4, 5, 6. So 6 years over the past 10 years where free cash flow has dropped. With that being said, we're looking at 15.9. The high was at 2021 at 25.8, but it's dropped down since then. Last year, $12.6 billion in free cash flow. It's growing at a 3-year rate of 6%, 5-year 7.7. So pretty moderate growth here, pretty consistent with the profit, but I would say moderate growth, not high growth. But again, mature industry, mature business, this is what we would expect to see. We're not looking at a new up-and-comer tech stock. We're looking at a retail, classic business, dominant business, number one in the nation at $680 billion revenue. Costco is second and Walmart is first. So you got to keep that in mind as we go through this. Debt to free cash flow. How quickly can the company pay off its debt with the cash generation that they're producing? So we want to look at an average over the past 5 years, 3.5, past 3 years, 4.0. So they're averaging about 4 years to pay off their debt with the cash flow that they're generating. 52.1 billion currently in debt with cash flow of 12.6 billion. That's 4.1 years. We like anything under 5 years. We love anything under 3 years. I don't care how strong a business is, there's always something that can disrupt the business. So you want a company to have a strong balance sheet and be able to pay off their debt quickly with the cash that they're generating so that they can stay out of trouble and sustain. Having a bad balance sheet, being over leveraged is one of the number one, having a bad balance sheet and being over leveraged is the number one reason that businesses go out of business. So you always want a business that has debt to free cash flow less than 5 years, 5 or less. So let's move on to the next. Debt looks pretty good. Let's look at this dividend. Right now, 0.91% over the past 12 months. Every quarter, you're getting 24 cents per share currently, and they have a payout ratio of 40%. That means out of the free cash flow that they generate right now, Walmart is paying 40% of that free cash flow to dividends. So this means they have a lot of room to grow this free cash flow. Let's look at the growth rate over the past few years. We have 13.2%, 9.2, 1.7, 1.8, 1.8, 1.8. So not a lot of high growth. The past 2 years, definitely well above average dividend growth, 9.2 and 13.2. They are in position to continue to grow that, looking at their cash flow that they're generating and the fact that their payout ratio is sub 50%. So this can continue. We don't know if it will, but that is a dividend policy that I can expect from a company of this size. Going back a few years, so they have some dividend growth, but not significant. So over the past few years, they're growing their dividend every year, but they're growing it at a very incremental rate, not very high. It's below the S&P 500 average. So right now, I would say this is probably not the best dividend growth stock. These past 2 years, they do have a dividend growth stock trend, but that's only 2 years. It's really not enough to trust that going forward. So dividend policy, not bad, but again, not great. Shares outstanding. We want to look at the shares, the trends of the shares, and we want to see, are they buying shares, which means they're increasing the value of the current shares by giving those existing shares more of the business, or are they selling shares, growing the share rate, diluting the current shareholders? So as we see, Walmart has a very strong, one of the strongest trends of buybacks that we've seen. So from 2020 all the way down to 2025, we see they've gone from over 8.5 billion shares now down to almost 8 billion shares. So they're buying, it looks like about a little bit less than 100 million shares per year. So they're taking some of that free cash flow, which is why they may not be growing that dividend at a very high rate for a long time, because they are taking some of that cash flow and not just adding value to you, the shareholder, through a dividend, adding value to you, the shareholder, by reducing the number of shares. So each time this happens, the existing shares become more and more value. As this comes down, earnings per share goes up, not just from the company growing, but from the company reducing the number of shares. So the rest of the earnings get spread out to less and less shares. So we love to see this. This is great for a mature company. This is what I would expect and hope that they're doing with their free cash flow, reducing those share counts, giving me, an existing shareholder, more of the business. Another important metric I love to look at, I want to know, is this company creating economic value? It's one thing to have a profit, meaning you brought in some money and you have money left over, but based on the capital, based on the money that you have to use for the business, what's your return on the capital, not just the revenue? So we want to know what's that return, and we want to know that return compared to the cost of capital, interest on debt, and opportunity cost when you put that money into the market instead of the business. So with that being said, their return on capital, 14.79%. Their cost of capital, 5.6. This is how much it costs them to have the debt and equity in their hands to use for the business. 5.6%, and they are earning 14% on that. That's a spread of about 9%. So that's positive. Over the past 5 years, they're averaging about 9% as far as how much value they're creating economically, about 9% per year. So that looks good. So with that said, let's look at the valuation, and I'll let you see where I'm at with this company and why. So they're averaging about 5.4% growth over the past 5 years. I think they'll probably stay along those trends. And so I'm estimating about 5% growth there. Their discount rate, remember their cost of capital was about 5.6. So I think 10%, I think there's some margin of safety there instead of using the 5.6. I think that's a pretty hefty risk premium for this type of business. Terminal value, I'm estimating if I were to buy this stock today, in 5 years, I should be able to sell the stock for at least 31 times free cash flow. For reference, right now it's selling for double that, selling at about 62 times free cash flow. So I think this is a safe estimate as far as the terminal value, 31 times free cash flow. With that said, with their current free cash flow of $12.6 billion, I'm estimating that the intrinsic value of this business, of Walmart, is about $43, somewhere between $39 and $47 as my fair value range. This represents a potential downside of 55%. So quality business, strong business. They are at the top of the mountain. There's no signs of them being thrown off of that mountain. The next closest thing to them would be Costco. Walmart is still way ahead of Costco right now as far as revenues, as far as top line growth. I think Costco is probably a better quality business based on margins and their opportunities for growth. But right now, Walmart is still the behemoth that is going to stay there for a long time. With that said, quality business, strong business. I wouldn't say this is a sell. This may be a hold, maybe not a sell rating. But again, you're looking at potential downside. If you agree with my assumptions, a potential downside of 55%. So not the time to grow and grab a lot of shares of Walmart right now. Definitely a watch list. I watch this business. So if that stock comes down sub 50, I would definitely be interested as a long time hold. So that's my estimate of Walmart. I hope you got something out of this. Let me know what you think in the comments, and I hope to see you in the next video.